The phenomenon of a disconnect between stock market performance and the broader economy has puzzled economists and analysts for decades. This disconnect refers to the situation where stock market indices reflect strong performance, while key economic indicators such as unemployment rates, GDP growth, and consumer spending show signs of weakness or stagnation. Historically, such disconnects can be traced back to several key moments in economic history. One of the earliest prominent examples occurred in the late 1920s, leading up to the Great Depression. During this period, the stock market experienced a significant boom, driven by speculation and an influx of new investors. However, underlying economic conditions were deteriorating, culminating in the stock market crash of 1929, which triggered a prolonged economic crisis. Fast forward to the early 2000s, the dot-com bubble provides another illustration. The late 1990s saw stock prices soaring as technology companies grew rapidly. However, many of these companies were not profitable, and the economy was not in line with the market valuations. When the bubble burst in 2000, it led to a sharp decline in both stock prices and broader economic malaise. The 2008 financial crisis further exemplified this disconnect. In the years leading up to the crisis, stock markets surged to record highs, fueled by easy credit and aggressive financial practices. However, the real economy faced significant challenges, including high levels of household debt and declining housing prices. The eventual collapse of the housing market and subsequent financial crisis highlighted the dangers of a decoupled stock market. While the stock market rebounded relatively quickly after the crisis due to monetary stimulus and low interest rates, many segments of the economy experienced a slow recovery. More recently, the COVID-19 pandemic has created a notable instance of stock market economy disconnect. Following the pandemic's onset in early 2020, the stock market experienced a sharp decline as uncertainty gripped investors. However, unprecedented fiscal and monetary support from governments and central banks worldwide, including stimulus checks and low interest rates, fueled a rapid recovery in stock prices. As vaccination campaigns progressed and economies began to reopen, stock indices reached new highs. Even as many businesses struggled, unemployment rates remained elevated, and economic recovery was uneven across different sectors. This disconnect can be attributed to several factors. First, the stock market is influenced by investor sentiment, speculation, and future growth expectations, which may not always align with current economic conditions. Second, large technology companies that dominate stock indices often perform well independently of broader economic trends. Their profitability can drive market performance, while other sectors lag behind. Additionally, the increasing role of quantitative easing and stock buyback